Welcome, everybody, and thanks so much for being here. My name's Brady Plunkett, and I'm going to be co-presenting today with Louai and Braden. These are colleagues of mine at PWL that will be taking over shortly. We're super excited to be here. In practice, we get a ton of questions from clients that are business owners. We interact with a lot of accountants for shared clients that are business owners around common problems that come up around developing a compensation strategy. Later on, when you're retired, how to get money out of your corporation tax efficiently, just the whole nature of being a business owner, having a corporation that has wealth, and what are the planning considerations involved with that. So we've put together a deck of information, of ideas that we're looking forward to chatting with you today. The other really key piece is, over the years, we've realized that we've needed a bit of a better, more robust solution to answer these questions. So a number of years ago now, we hired Braden, who's here on the call, to help develop an advanced planning calculator towards using a pretty robust model of helping us answer these decisions that people are asking about, as opposed to just using rules of thumb. We are going to get into a demo a little bit later, which is going to be pretty exciting. In the meantime, we've got two other people from PWL, Mathieu and Nikki D, who are in the chat available to answer questions. Please put questions in the chat, and they will be addressed, barring that there's not so many of them. And aside from that, I think we're ready to roll. Let's do it. So there is an interactive software that we would love everybody to use to engage with us today. It's called Mentimeter, and we're going to be asking questions, asking for some participation via this platform. If you go on to www.menti.com and enter the code that you see, or use the QR code, that would be awesome. We'll let everybody, we'll give everybody some time to do that. And I think there's going to be a top kind of header otherwise that people can refer to. So I think we're ready to keep going, Braden. I briefly mentioned there's going to be some information, some ideas that we're going to talk about early about how to compensate yourself. We're going to get into a demo with the calculator to give you guys a sense of how we work through, call it client problems. And your participation and engagement through the chat is most welcome throughout. So I'm going to pass it over to Louai to kick it off.
Okay, welcome everybody. We wanted to kick today's session off with an open-ended question, and we'd love to know, as business owners, why are you keeping money in your corporation? And there's no right or wrong answer. It could be for tax purposes, it could be for business growth, tax economy, great answer. Feel free to put the answers in the Zoom chat as well if that's preferred. A lot of taxes. Cool. We're going to give a few moments to let these answers roll in. And if you do not keep money in your corporation, we'd love to hear why as well. There's no right or wrong answers. While we're waiting, I'll kick things off. I'm a dual citizen. I'm a U.S. citizen as well, and the IRS is already there are plenty to deal with when you're just a personal filer, let alone when you're a shareholder of a Canadian corporation. So it's all good. Okay. Tax economy, tax deferral. And if it's okay with everyone in the audience, we might pick on certain answers and ask you some more open-ended questions. And we'd love it if you could put those answers in the Zoom chat, if that's okay. Let's see. Is there any question that I want to pick on here?
They're all kind of similar, eh, Lou? Just minimize how much you're paying in tax.
Yeah. Capital gains tax. Okay.
Lucy asked a great question. Louai, if you want to read that one out.
Yeah, is it?
Sorry, not Louai. Louai, pardon me.
Got the same name. Can you invest income pre-tax in a corporation to defer tax? So you can certainly defer tax, although it would be pre-personal tax. You would have to pay corporate tax on those earnings first, and then you could invest the net proceeds, and that would defer tax depending on what investment vehicle you're using. But it's a great question. Braden, any thoughts on this?
Yeah, so it's not sheltered like an RSP. So any investing that takes place in your corporation is subject typically to more punitive levels of tax initially for reinvestment income. So unlike an RSP and a TFSA, where those types of income are tax sheltered, that's not the case in a corporation.
I advise to pay. There's a great answer from Chris in the chat. Cross-border planning. I advise to pay out to avoid guilty, and that's the. I sent a message about this in our group chat yesterday. But otherwise, to pay out capital dividends and other types of dividends if the notional balances are available. That's a great answer. That's a whole topic on its own. I think it's an awesome one, especially as a dual citizen. But great response. Okay, so we've got a follow-up question. If we can move to the next slide, please.
Yep.
What is your compensation strategy today? Is it dividends only, salary only, or are we doing a little bit of both? Okay, lots of just salary, just dividends, a little bit of both. Okay, cool. The mix is coming up.
That's super fascinating. I've seen a lot of situations that just pay dividends, and they're super happy with the tax rate that they achieve on that, and that's enough fuel for them to continue that strategy going forward. Would anybody? This is amazing. This is almost a third. This is great. Would anybody be happy to put some reasoning in the chat as to why they are selecting the option they did? My accountant told me to. RSP and CPP. Yep. I just picked salary because I don't know better. I don't have an accountant. RSP room. Lou, I'm gonna give this back to you, but I just want to step in and comment. This exact slide is actually why we set out to build something, is because there is no consensus that you can find as to what is obviously most optimal for you. It is dependent on your circumstances, your goals, your objectives, and it's really not an easy decision. And it's tough to give advice on all the same, even with this great software and technology that we're developing. But this is fascinating to me.
Amazing. Okay, yeah, pretty much a third. We're going to ask you one more follow-up question that a lot of you have already answered in the chat, and that's, how was your compensation strategy decided? So lots of accountant advice, or I didn't know any better, which is totally okay. That's why we're here today. I would love to hear about what kind of considerations went into this decision. So I've seen some RSP rooms, some CPP. I saw somebody comment to release notional accounts, which is a great answer. Let's see what comes in with accountant. In consultation.
I think we found a theme here, Lou.
Yeah, I think so. Don't wish to pay employee and employer CPP. Okay. Salary, no choice for now. I don't want to qualify it as a personal business. Okay. First, I really like the answer in the bottom left, which says, I've amended it over time. I initially disliked paying into CPP, but now I appreciate the diversified guaranteed income. That's a really great answer. I was already in my 60s when I incorporated, so pay a minimal salary to myself. You can now pay dividends to my spouse as well. Okay, yeah, it's really tough when you're kind of faced with this decision, salary versus dividend, at that age, so close to possibly collecting your public pensions like CPP. It makes the decision a little tricky for sure. Cool. Okay, so
there's a good amount of overlap.
Yeah, tons of great answers. Let's move on to the next slide. So we have now understood why you've chosen to keep money in your corporation or not, how you've decided to pay yourself and why. Let's kind of explore if there's an optimal option for business owners available and what that may look like. I do think that it's useful for us to start looking at some of the salary versus dividend considerations. Let's look at pros and cons of each. And let's start with the salary, for example, and let's start with the pros. So the pros of salary are pretty straightforward. You generate RRSP room. The salary is deductible to your company. You're eligible for CPP. So salary income attracts those premiums and results in retirement income from CPP later on. And then when you go to renew your mortgage, refinance it, you apply for insurance, salary income is highly favored by lenders. That's not to say that's not the case, for dividends, but we'll look at that a little more. And then what's so beneficial about dividends? So they're taxed at a lower personal rate, and we'll explore this very shortly. You don't need to pay into CPP, so dividend income does not attract those premiums. And there are certain types of notional balances. So for example, a really easy example, and this is a big discussion on its own, is the tax that you pay on investment income in your company. This can be refundable to your corporation, but it requires dividend income. Salary income does not do this. It does not release those tax balances. So that's a really big pro of dividend income. Some of the cons of salary, for example. So your income tax is withheld at source. You're forced to pay into CPP, and some may see this as a good thing, some may see this as a bad thing. If you're hoping to pay yourself, let's say you wanted $100,000 to land into your bank account. If you're looking at salary versus dividend, you likely have to pay yourself a higher salary amount to account for those higher personal tax rates. And then in terms of cons for dividends, no RRSP room accrues. It's not deductible to your company when you pay yourself a dividend. So any dividend that gets paid out to you as a shareholder is from after-tax money in your corporation. When you go to renew your mortgage, refinance it, apply for insurance, it's a little trickier. And this is coming from, I'm an ex-banker in my past life, and dividend income for those kinds of transactions are tough. And then no CPP benefit. And this is kind of assuming that you've never paid yourself a salary or you don't have any salary history. So you lose out on a pretty incredible retirement income stream. So we've looked at the pros and the cons. And what I'd love to do now is look at a live example of this, but we're going to start with just a quick concept. And this is really important to this discussion, which is tax integration. So what is tax integration? In simplest form, it is an effort by the Canadian tax system to create an equal tax experience, whether you pay yourself salary income and you've only paid personal tax, versus if you pay yourself dividends and you've paid some corporate tax and personal tax. The end result is it should be the same tax effect. So that's really the big theme here, is that I think many folks come into this discussion with the preconceived notion that dividends are superior because you pay less tax. But I don't think this is truly how it works, or at least I think it's not looking at the full picture. So we'll actually go through an example here. So we've put together a slide where we're going to actually look at, excuse me, what tax integration looks like. We've used Ontario rates, tax rates from 2022, and we're going to look at based on salary or dividend only income, which option maximizes the after-tax money in your personal bank account on let's say a 1-year basis. So there's two kind of major assumptions here. It's either form of compensations paid out to one shareholder, and that in either scenario, there's $100,000 of earnings in a company. So if we look at dividends only to start, we can see there's $100,000 of corporate income. There's no deduction for the salary. We're seeing some corporate tax paid here. This $87,800, this is the after-tax money left in the company after those taxes are paid, and that's what gets drawn out as a dividend. We see personal taxes paid, we've assumed 47%, no CPP premiums, no sort of tax credit or deduction for those premiums. So we've got almost $46,000 of after-tax money in your personal bank account at this rate. So you pay a little over $54,000 in tax between corporate and personal taxes. On the salary front, we can see a very similar concept. We see $100,000 of earnings, $100,000 of salary, which is fully deductible to the company. So there's no corporate taxes payable in this example. We see personal taxes paid at 53%. We see CPP premiums paid on behalf of the employee and the company. We see a small tax credit and a tax deduction for those premiums paid. And the cash available to you personally after everything's said and done is about $41,500. So there's a $4,300 difference here in this example. But what I'll note is it's very easy to look at this and say, wow, dividends are clearly the way to go because I've got more money in my pocket at the end of the day. But this doesn't look at the big picture, which is that there's a guaranteed retirement income stream for you later on. It's hard to envision that now when you've got to pay a little more now to get some more later. But it's a really important consideration. And Braden's demo is going to look at the holistic picture of everything incorporated. So it'll be a really great exercise. All right.
Great
we're going to pass
example,
it to
Lou.
Brady. Thank you.
Yeah. We're going to get into the taxation of Canadian private corporations here a little bit and the different characteristics of what goes on in companies. The one thing that I want to speak to just before we move along is point number 3. You'll see notional accounts. If you're a business owner here and one of your questions is, what are the opportunities to tax efficiently take money out of my corporation? My feedback today is please consult with your tax accountant to understand what the notional account balances look like inside your company. They are going to be different based on whatever levels of activity have taken place inside your company. There's a capital dividend account. There's a GRIP balance. There's refundable dividends that are on hand. Understanding what these notional accounts, because they are tracked on your corporate tax return, are important avenues to have a conversation to understand what can be pulled out in the most tax efficient manner. We'll move on from here though. True or false? All forms of income generated inside my company are taxed equally. And what I want to preface this with is, let's say you're generating revenues and you've got a big GIC in your business as well. Are those going to be subject to the same rates of tax? That might be a better way of framing it. Well, we didn't really split the room with this one, did we? False. You guys are awesome. That's correct. They are not taxed equally. Let's move on, Braden. To that last point, to that last slide, there are differences in straight revenues versus interest on a GIC. It's active versus passive types of income inside corporations that we'll get to. Here's another question. If you think about passive income, like a portfolio of stocks and bonds or a GIC, in Canada, there is a small business deduction where corporate revenues from business generating activities are subject to a more attractive rate of tax. That starts to get clawed back a little bit if passive income from other investments gets too high. At what level does that happen? We also didn't split the room with this one. We have a very smart audience. For those who haven't voted, yeah, it's at $50,000 of passive income. The small business deduction starts to get reduced. That is the starting point. The end point, because it is kind of tracked by thresholds, is at $150,000 on the long side is when the small business deduction would not apply because there is too much passive income at that point. Now, these are not active revenues. These are like sales. This is strictly passive income from other non-business generating investments. Good stuff. Let's keep going. One of the considerations when you think about holding stocks, bonds, GICs, or retirement investments inside your operating business is the fact that we're now in a higher interest rate environment in the world where there's different implications and thoughts on the small business deduction than, let's say, 3 years ago. Let's go back 3 years in this example to, let's say you were getting 2% on a bond. It would take, based on this chart, about $2.5 million worth of assets before an annual yield or return on that bond in this example, where you would start to surrender your small business deduction. But we're in a totally different place in the world where as of about a month ago, you could have gone to a bank and got a 1-year GIC worth 6%. So in this example, one of the takeaways is, given the fact that interest rates are now much higher in the world, it takes a lot less in terms of passive assets before you need to be cognizant that your small business deduction might start to get impacted. That $2.5 million now shows about, or now becomes about $833,000 worth of assets today, before you might need to keep an eye on what's happening to your small business deduction in your company. Let's keep it moving. So we got 100% success rate on the last two. So we need to switch it up a bit. There's no way you can get 100% on this one. Just in general, how are Ontario and New Brunswick different than other provinces? Surtax, no idea. There are some people that are on the right track here. This is super cool. Tax. I'm not taking the bait here. If you say tax, you're probably right. I think by default you have to. One is a terrible hockey team. Hey, be nice to the Leafs. I don't think New Brunswick. There's no hockey in New Brunswick. Is there a Q? There's a team in the Q probably in New Brunswick, but not in the NHL. Small business deduction different from the feds. 50K maximum passive income differently, not fully integrated. HST. These are great suggestions. Let's move along if everybody's submitted something, because I think a visual would be great to talk about the differences between Ontario and New Brunswick. So just to be clear, the small business rate, I think this is for Ontario, is on 12.2%. So on the first, what this chart is saying is on the first $500,000 of sales, of revenues, of active income that's contributing towards the Canadian economy, companies, private corporations in Ontario and close to New Brunswick too, are taxed at 12.2%. Great. Let's say there are no other assets in this operating business and revenues exceed $500,000. Well, upwards of 500,000, you are subject to a 26.5% general rate for revenues above that point. That's without any passive assets. Now we're going to throw a little bit of a twist into the equation. Let's say that same company is earning the same level of revenues in the previous example, 500,000, and then the company does a lot better and they have a great year and it's above that. But let's say in that business, there's a number of GICs or bonds or stocks that are held there for various purposes. Let's say the business owner's retirement. Let's say it's a high interest savings account for emergency funds, something like that, that's not classified as straight revenues. In Ontario and New Brunswick, but not the other provinces, if the amount of passive income starts to exceed 500,000 and up to 150, there is what we call a mid-tier rate that starts to get applied for active income. Depending on, and there's a slice there right in the middle, depending on how much is being earned. So let's say there is $150,000 of passive income inside this company. Well, an 18.2% tax rate is now applied on revenues from $0 to $500,000, and then the 26.5% above that, which is great relative to the other provinces that actually don't have that. So Ontario and New Brunswick do have a slight advantage to holding passive assets inside operating businesses relative to other provinces because they don't get escalated to the 26.5 right away. There's still a mid-tier rate that they're subject to. And now that you're thinking about how much you're expected to pay yourself, now that you're thinking about how much passive investments to keep in my company and the differences between the taxes on my revenues and your passive investments, what does this mean when it comes to selling your business? I'm gonna put it back to Louis to talk about some considerations there.
So this isn't perfectly correlated with how you should compensate yourself, in terms of salary or dividend, but this is a really good consideration as you progress through your business career, and maybe you're looking to start selling your shares of the business. And we want to be mindful of passive assets in the company, and this is where really deliberate and intentional planning is key. So we're going to focus on the lifetime capital gains exemption for qualified small business shares. We're going to ignore farming and fishing properties for the purpose of our presentation. And at a high level, what the lifetime capital gains exemption is let's say that you sell your business for $1 million total capital gain / profit. There is a tax measure available, and in 2024, the limit is now going to be, I believe it's $1 million. Where you can actually claim an offsetting deduction relative to that gain and hopefully end up in zero taxes or as close to zero as possible. And how that works in practice is not as perfect as the way I've described it, but we'll keep it simple for today. So in 2024, let's say you sell the shares of your small business and it's $1 million capital gain. You've got an offsetting $1 million capital gains exemption, zero tax, perfect scenario. So that's the perfect scenario here. And we're going to go through what some of the criteria looks like in this regard. So it needs to be a Canadian private corporation, primarily operating in Canada, 24 months prior to selling the shares. 50% of the assets in your company need to be used for active income. So we do not want these to be generating, or at least more than this threshold, to be generating passive income. When you go to sell the shares of your business, 90% of the assets in the company need to be used for active income. So this makes things a little bit more restrictive now. And you also need to be able to prove that you've held the shares, you've owned them for at least 24 months, and that you've owned them indefeasibly, which means that you have total discretion over selling them to whom, to when, for how much, and that there's no forced sale of any kind. But so on that note, we're going to move on to the next slide, and we're going to tell a little bit of a story, is a good way to put it. So let's say that you've started a business, you've accrued a ton of earnings in your company, you've saved a ton, you've got this big investment account in your corporation, you probably have some TFSA accounts built up, or you've got an RSP that's built up, and you want to maybe sell your business. Maybe you just have a holding company and you want to figure out how to draw from it in retirement. Which pots should I take money from? Why should I do it? How does this help me stay efficient in terms of inflation, tax, just my income needs in general? This is exactly what Braden's Advanced Planning Calculator, the APC, has accomplished. It's a really exceptional tool, and he's built a withdrawal algorithm that's applied. It's a pretty static algorithm that I think is exceptional. I was actually just looking at one before we jumped on this call that ranks the sequence of withdrawals for business owners from highest priority to lowest in terms of tax efficiency and inflation. And then, of course, you'll see at the very top, we have minimum RIF withdrawals, Canada Pension Plan, Quebec Pension Plan, and Old Age Security. At a certain point, you have to take these incomes. You can't, it's very tough to manage. So we've got those as a high priority. But everything below the Canada Pension Plan is optional. It's based on your circumstances, and they're optimized based on your circumstances as well. And Braden's going to go through an excellent demonstration that shows this.
Just as we progress towards Braden, one of the key features of our advanced planning calculator that is super relevant for business owners is the individual pension plan. So this is a defined benefit plan that business owners create for themselves for retirement. It is the alternative to investing in RSPs. It's actually an evolution of RSPs designed specifically for business owners. And I typically refer to it as an RSP on steroids. After age 40, the contribution room that is available for investing in an IPP becomes much more higher than the RSP alternative. It still comes with the tax or the income splitting benefits when money comes out of the IPP. You can invest money there according to a specific investment strategy that adheres to you. And in many years, you can actually go back and pick up unused or extra RSP room from years, like even if you're setting up an IPP after age 40, but you're not retired yet, you can still go back and pick up past years worth of service in terms of contributions. It's something to definitely check out if you're a business owner. And to bring this back to an original concept earlier about how to pay yourself, is that you start to create room that can build into an IPP by taking salary. That was one of the charts that Louis provided. By taking a dividend only approach leading up to setting up an IPP, it would result in less contribution room available into the IPP when it eventually gets set up. There's a question in the chat: wouldn't one of the advantages of the IPP be that you can't fund a spousal RSP? You did mention income splitting just now. You're absolutely correct, but the income splitting technique and advantage still does apply. And I would even go a step further to say, because it's actually pension income, you are able to split it with your spouse at an earlier age than a spousal RSP, which would only kick in Canada and be available if it comes out of a RIF at age 65. Versus an IPP, which is considered pension income that can be done actually earlier than that. How can business owners use IPP if they are DIY investors using low-cost ETFs? This is one of the biggest challenges for DIY investors. It's great. You need to partner, Akash, with an actuarial firm. This is actually one of the disadvantages of an IPP, is there's a lot of maintenance and upfront work involved in setting it up, getting statements organized, sharing information. You do need to partner with an actuarial firm in order to set one up. But once it is set up and the facility's there, yeah, you can actually invest in low-cost ETFs inside that facility. It is an option. Let's keep it rolling, if that's okay. The final lead-in to Braden's tool, which is coming up very shortly, is it would be very interesting to get everybody's perspective on what their savings approach is right now, or what their saving strategy is right now, given the fact that their business is an opportunity to save into. There's corporate investing, there's RSPs, there's TFSAs, and then we've seen people take a hybrid of both. So if we go to the next slide, what we are going to ask you is, which strategy have you implemented? Combination. What is the fee drag with an IPP when partnering with an actuarial firm? Sean, I'll take this while people fill out their answers. There's higher upfront costs to set it up. I think you can count on $2,500 a year of maintenance fees that are paid to the actuarial firm in order to get this set up. Some of them, I mean, there's a mandatory report that's due every 3 years in terms of evaluation report of the plan. Most don't charge for that as a one-off. So I would guess once it's set up, about $2,500 a year. And Justin has a question about corporate-owned life insurance. And if somebody wants to include our recent white paper to maybe share some contrary ideas to what you just mentioned, that would be fantastic. But it's a great point. Okay, so we've got a combination of everything in terms of strategies that have been implemented. That's great. And 0% for the PWL team has made me reconsider. Maybe we'll go back to this, Braden, after you're after you're done sharing, and maybe that'll be it. Maybe we'll get some votes. Does anybody want to share their reasoning behind taking the approach that they have in terms of where they're saving their long-term money? Max registered accounts and everything else stays in the corporation. Perfect. Cool. Let's send it over to Braden to have a look at the PWL Advanced Planning Calculator.
Thanks, Brady. So I think at this stage of the presentation, Brady and Louis have done a great job of outlining the pros and cons of both approaches of paying salary from your corporation or paying dividends, or maybe you pay a salary and set up an IPP. There's a lot of different things to consider, and that's really the genesis of why we built the software internally at PWL to help answer these questions. So we're going to walk through a bit of a case study here. So we've got Sheldon and Amy. They're married. Amy has a corporation that makes about 300K of net earnings a year. And Sheldon, the spouse, is a professor and he makes 185K of salary a year, also has a defined benefit pension with the university. So the question is the same question you guys all have for yourselves is how should Amy pay herself from her corporation? So what we've done is we've modeled this case using our financial planning software that we've built in-house to look at some of these strategies. So just to keep things simple, I created 3 different plans. I created a simple dividends from the corporation, a salary from the corporation while still passing through capital dividends when they become available. And the top one is an IPP. So we ran this analysis and ultimately, typically when we're doing financial planning for our clients, in conversations with the client, we realize that most clients fall into 1 or 2 buckets or a combination of both. And those buckets are the client wants to spend the most money they can safely spend from their investments, or the clients are content with spending below their means, but want to maximize multi-generational wealth. So that's how I've designed the software, is to put those 2 metrics front and center. So we have the final net worth metric here, and then the spending metric here. And when we're saying we're ensuring that they're the maximum amount that they can safely spend, we run this through a Monte Carlo analysis and ultimately find out what the success rate of that plan is. And at PWL, we say that we're looking for a 90% success rate to say that you can safely spend that amount. So what I've done is I've ran each plan subject to a 90% success rate, and overall the IPP generated the highest amount of spending. And if we look at the numbers, we're looking at, an extra $1,000 a month of spending after tax for the household. So that could be $12,000 a year. That could be an extra vacation for the household. I'm sure you guys can think of lots of ways to spend an extra $12K without sacrificing any of your financial goals. So taking a deeper look into the IPP case, we can take a look at the dashboard and see just an example of what you might expect if you want to follow this plan over the course of your life. We can take a look at the cash flows chart, for example. So the dark blue line, the navy blue, is salary. So we see that the combined salary for the household is about $360K. So that means the $185K that Sheldon was earning from the university, plus a $175K of salary that Amy's paying herself from her corporation. And that lasts throughout the working years. And then in retirement, we see things shift. And we see at the bottom that there's an IPP benefit of about $85K a year, along with a defined benefit pension from Sheldon from the university of about $96K a year, along with CPP benefits and some RIF withdrawals and some taxable withdrawals and some corporate dividends to go along with it. So the nice part about our software is that algorithm that Louis outlined before is all taken into account. So that entire withdrawal strategy is implemented for every strategy year over year. So it's making that decision of where to pass, where that cash flow should come from to fund consumption. And we're just illustrating what that might look like. And if we wanted to flip it over and see how that might compare to a salary strategy, it looks quite a bit similar during the working years, where we're still taking 175K of salary from the corporation, but the retirement income looks quite a bit different, where we now have a much larger RIF withdrawal because we're taking that salary to max out RSP contribution room in the working years for Amy, which leads to a higher RIF withdrawal during retirement. And we no longer, of course, see the IPP benefits. And then finally, just to take a look at the dividend case, things are quite a bit different in terms of cash flow. We see the only salary is the 185K coming from Sheldon at the university, and now we're withdrawing dividends and any money from a taxable account that may be accumulating. We're using that towards consumption as well. So I'm going to take a pause there and see if anybody has any questions that are coming in that we might want to dive a bit deeper on.
That was great, Braden. I think it might be worth mentioning that these outcomes, or these, what the optimal decision is going to be different for everybody. It's going to depend, what your lifestyle needs are, how much money you need to retire, and a number of different things. We're not tax accountants, and we're not trying to be. We're actually trying to work with tax accountants to arrive at the most optimal outcome for everybody when combining tax considerations with considerations around what personal goals are. The other thing that we see in practice, especially when people are drawing from companies, is that it does cost money just from an operational basis to have a company. There's tax filing requirements. There's requirements to build financial statements every year. So we try to put that into the equation as well when trying to figure out, sometimes we're asked, how long should this company be alive for in coordination with generating my retirement income? So that's another thing that can come up sometimes. Kent asked, and this is one for you, Braden, does the IPP scenario take into consideration the associated expenses of maintaining it?
Yes, absolutely. So without diving in too much detail in the software, that the actuarial expenses is a user-defined input. So the financial advisor can take a look at your situation, and whatever the actuary is quoting you for implementation, we can include that in the fees.
Do you have this one handy, Braden? Scott's asking, what's the assumed tax rate on the corporate assets upon death?
Oh, great question. So upon death, we're actually looking at 3 different estate planning strategies. So we look at the default case, which is a triple tax case, which is what we want to avoid. But then we're also looking at the loss carryback strategy and the pipeline strategy and the pipeline with bump strategy. I'm not going to get into those for those of you that have no idea what I'm talking about, but some of you guys might be familiar. So what we're doing is we're comparing all of those estate planning strategies together every time we run a simulation, and then we'll present the optimal estate planning strategy. So in this case, it happens to be loss carryback. So this quoted post-tax net worth assumes that we're applying the loss carryback strategy. So that's what we would actually do with our clients in this case, is work towards applying the loss carryback strategy when we go to wind things down at death.
Yeah, that's a great question.
Do you guys have any thoughts on, I'm just looking at Louai's question towards the top with regards to a trust owning shares of an operating company, and in terms of legacy planning and tax efficiency? I think it's a loaded question for sure, in my opinion, and it would be important to understand your organizational structure and objectives a little bit better. But any high level thoughts on your part?
For me, it's not something we've modeled currently. Definitely on our radar of something that is definitely an interesting thing for us to look at moving forward. Maybe I can pass to Brady if he has any comments on implementation of stuff like this.
Yeah, no, good question, Louai. I would say definitely a question for a tax accountant. What we have seen in practice is a trust that has ownership of shares in an operating business can be very interesting as it relates to using lifetime capital gains exemption limits. So if you've got a large family, for example, what I have seen is a certain organization chart that involves the trust owning the shares, like I mentioned, and upon sale of a corporation, the lifetime capital gains exemption, if the planning's undertaken properly, can be used towards multiple beneficiaries of a trust, like the owner, like their spouse, and like their kids. And multiplying the usage of the LCGE, the lifetime capital gains exemption, can lead to saving more tax in planning for a sale of a business. Have you had any experience with TOSI challenges? Is any income from the corp assumed to be split? So we have had challenges with TOSI since its introduction in 2017. It's made income generation opportunities from a private corporation much more challenging. We have received consensus from a number of different accountants that at age 65 for the shareholder of the business, given the legislation today, you are able to split income from the corporation. So we factor that into our planning, and based on every situation, if there is a need for cash flow before 65, we need to be more creative and proactive and forward-looking on how we're going to split income right up until 65. But typically, in most situations at age 65, most families are in a pretty good place when it comes to balancing income for their taxes personally. And I think in the APC, Braden, we're assuming that it can be split at 65. Is that right?
Correct.
Yeah. Cool. Do we want to move on to the next few slides here just to make sure we get to everything?
Yeah. Let's wrap it up. Let me make this bigger. Okay. So yeah, so if you guys are wanting to learn more about this stuff, I have a 50-page white paper that you guys can dive into. It covers all of the stuff that we talked about today. And more, and it covers all of the detailed calculations that I'm using under the hood to run these simulations in the software. So feel free to check that out. There should be a link in the chat, hopefully, that you guys will be able to find it. Cool. So we'll pass it back to Brady.
Yeah. What we've talked about today is just information en masse about how we would go about solving problems, how we understand the tax system to work in Canada, both corporately, and how that integrates with a personal situation. If you are interested in scheduling a meeting with us where you might have questions about your own situation, feel free to scan the QR code, and maybe if we just share the link to our calendar in the chat, that might also be helpful. There's no obligation for anybody to work with us. We've got white papers, podcasts. We've got a lot of information that we just share publicly with everybody because, we don't feel that there's not enough good research out there with access to information for these questions that people have. But if you're interested in getting into the mechanics of your own situation, we're happy to chat. Stephanie had a question just before I get here. Can you, sorry, I'm just going to scroll up. Sorry, I may have missed it, but I want to make sure if you can comment on shareholder loans and tax implications. So what I understand a shareholder loan in the context of what you're asking about, Stephanie, is a previous event where maybe money has been transferred into a company from personal funds. That is tracked as an available balance to take money out of the corporation and refund it without any tax at all. It's typically called a shareholder loan or a due to shareholder. If you do that, it's much more efficient in most cases, to transfer whatever available money there is back to you personally, because if investing money in the company, that would obviously attract passive income rates, which are much less attractive. So in many cases, it makes sense to pull it out personally. I don't think I introduced this slide. So this is a QR code. We're doing these at least once a month. We want to get better at how we approach these seminars and what our style is in answering these questions. Please feel free to fill it out and give us some feedback. The other thing, I don't know if I want to get into this. There's a question on a capital gains surplus strip. Maybe we have some time, so I might chat about it.
I think it's a great topic.
Yeah, for sure. So the capital gains surplus strip, I would say, is kind of the flavor of the month, because a lot of accountants are starting to impose their own deadlines for actually being comfortable with coordinating these strategies because of various new legislation that's coming into play on January 1st. At a very high level, it is the process of getting money out of a company at capital gains rates personally. You are walking a bit of a line with CRA in how this structuring takes place, at least now and definitely in January. It does involve prepaying a ton of personal tax up front. There's a lot of legal and accounting costs that you need to consider in doing it. It is not a slam dunk. The ones that I have seen where it's most advantageous have been where there is a big need for personal cash. Like let's say you've got a lot of debt to pay off. Or you've got an upcoming purchase that you want to make personally, and you've got all this money in your company. It actually involves kind of selling some shares in your corporation to another new company that you're going to add to your org chart. And in the process, you are paying capital gains rates personally to allow money to come out of your company. It's quite complex. It's not a slam dunk. There's a lot of fees. There's a lot of costs, but sometimes in the right situation, it can make sense.
I also think it's super important that there is an objective, like Brady said, attached to this. You don't do it just because the tax landscape is changing by any stretch. This has to be a goals-based exercise and transaction, and that should be the most important consideration going into this.
Sean asked, can you comment on the efficiency of investing in something like XEQT versus Horizon Swap ETFs within a corp? Yeah, we've touched on this on the podcast a lot, what the Horizon structure looks like, the relationship, I think, with National Bank and the default risk around that. As it's structured today, more of the income from Horizon Swap ETFs would be added to the capital dividend account and the CDA balance, because most of that return is categorized as capital gains, versus an XEQT or an alternative would have more money taxed as interest at the dividend and interest tax rates. And that would be added to the RDTOH, the refundable dividend tax on hand account, as opposed to the CDA. So it would just attract a different notional account inside the company. How does corp strip strategy compare to tax gains harvesting? Lou, do you want to take that one?
That's I would be curious, Stephanie, what are you looking to compare? Is it the overall tax experience, the transaction itself, and results? Correct. The tax experience. Well, you end up paying. Sorry, there's just another question that came in that just caught me off guard. So with the capital gains surplus strip, you do end up, like Brady said, you prepay a ton of corporate tax, and then you are taxed personally at a capital gains rate. With the tax loss harvesting scenario, you are taxed corporately, and then there will be a significant, hopefully, capital dividend that can be paid out to a shareholder tax-free. I truthfully haven't looked at a side-by-side comparison recently Brady, I know we've looked at a few not so recently. Any thoughts?
Yeah, no, it would be the difference between, so tax gain harvesting inside of a company would build the CDA account. Corp capital gain strip involves reporting that same gain personally. So it would depend on the income tax differences between yourself personally and what's going on in the corporation. And the capital gain strip would actually represent more money that you could pull out to yourself relative typically to what a CDA would represent in most cases. Any thoughts on Steve Smith's question, Louis?
Does integration make the small business clawback irrelevant to business owners who want to invest in passive assets in a business?
Versus their personal accounts.
Yeah.
I'm trying to reword this question, Steve. Are you saying, is it like, does it just make sense to pull the money out personally? If you could elaborate on what you're trying to get at, that would be really appreciated.
There's a couple of great resources from the tax and estate planning director at CIBC. His name is Jamie Gollenbeck, and he actually he doesn't respond to your exact wording of your question, but he does show some really excellent illustrations of money that is invested in a corporation versus a TFSA, for example, and how that grows over time. I just don't know if that's the info that you're after. Does it make sense to pull the assets out personally?
Yeah, it would depend on how much, and without getting into it would depend on how much assets there are. If there's a significant amount of excess cash in the corporation from a lot of the planning we've done, it actually does make sense to keep it in there, and you have to consider when you're going to pull it out and stuff like that. If it is a smaller amount of capital, based on a lot of the plans that we've looked at through the advanced calculator, for smaller amounts, it could lean towards pulling it out personally. You're correct. But it would depend on how much money you're talking about. And don't put that in the chat.
Steve, I'm going to link the article that I've shared this with Brady before. It's TFSAs for Business Owners by CIBC Jamie Gollenbeck. He'll show some cool illustrations that I think will be helpful, and he's got a version for the RSP as well.
That's awesome. And other than that, we're coming right up on 1 o'clock. I just want to say thanks a lot for everybody for attending and chiming in. We really enjoyed today. We hope that you got something out of it. Keep watching for our content that we're going to put out on the web, and have a great day.